Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of CIBC are hitting a record high. They're up 3.4% right now after first quarter results came in higher than expected. Profit topped estimates, and the lender also posted better than expected results in its capital markets business. There was also record revenue across all of its units. This marks the second straight year CIBC has beat expectations as the broader banking sector continues to see strong growth across multiple segments. Shares of TD Bank also moving higher, up by 1.25 right now. The lender posting profit in its latest quarter that topped estimates as well as revenue. It saw it jump 18% compared to the year before. TD also saw record revenue in Canada, helped by a rise in loans and deposits and strength in its wealth management markets. The quarter was also boosted by a decline in the lender's provision for credit losses and higher banking revenue in its U.S. division. Shares in Cascades are slipping after the tissue company issued a lower than expected profit forecast. Overall revenue also fell. Tissue sales lagged expectations. The company says sales were weighed down by a power outage at one of its facilities that impacted production levels, supply chain management, and added increased operating costs. The lower than expected forecast is due to higher transportation and energy costs due to weather-related impacts in the U.S. And taking a look at the markets, the TSX just on a roll right now. It's up well into sitting around record territory again, up 0.38%. The banks helping that, most of the banks helping that. And south of the border, well, it's kind of a mixed bag. Oh no, not anymore. Everybody's in the red right now. It was early, but now S&P 500 up by more than a point, the Dow by 0.44. And the NASDAQ, NVIDIA, and other tech stocks dragging that down 1.83%. It is off. All six of Canada's major banks have released their quarterly earnings this week, and all six outperformed. The sector posted strong profit growth and record revenue fueled by wider interest margins, higher fee income, and solid trading results. To help us break down what's behind the numbers, we're joined by Steve Rawls, Senior Portfolio Manager at Trivest Wealth Counsel. Steve, thanks as always for joining us.
Great to be here, Roger.
Good, solid numbers, but they're the banks. Are people going to be happy with what they're seeing?
They're the banks. Yeah, I think people will be happy with what they're seeing. I think CEOs are going to be happy with what they're seeing. Broad-based beat across the board, double digits. But most importantly, I describe it as diversified revenue streams really paying off in all categories, in all segments. Very positive day for the banks. 6 for 6. Can't ask for much more.
And that diversified, that's important. What are they doing right? What are the individual banks doing right? Is there certain areas one is outperforming the other?
Well, I'd say like one thing that they're doing quite well on is benefiting from the market altogether. The wealth management was an incredible component of their profits last quarter. We saw Royal Bank increase of 32% on the wealth management side. Capital markets also benefiting. But what's really helped out across the board is the benefit of having a proper yield curve, and the net interest margins were quite healthy across the board as well. So it's right place, right time in the right markets, and things worked out quite well.
And with the wealth management, any concerns? I mean, what goes up can go down?
What goes up can go down, but it is quite sticky money with the private wealth side of the business. Fees are what they are, and it has been quite positive. So I think that as long as the market continues to do well, as we're seeing in Canada and diversified portfolios, that we expect to see continued growth on the wealth side.
And losses, I saw a couple of banks actually were lower than expected, and overall they didn't seem that bad.
Yeah, we're seeing that in Royal Bank. It's actually down a little bit. I think was close to 2% down, and it is the bank. It is the biggest. It is the one that makes the most money, and there is some profit taking there. I believe it looks like from a valuation point of view that it is the highest value from the valuation metrics. there are concerns about that perhaps how much more growth can really happen in the market from a value point. Like I would describe most of these banks as being fairly valued. They've had a great year, but how much more room is there to go? That is a question out there.
Yeah, I think that is the big question. So what can we expect moving into 2026? What might be some headwinds or concerns?
Yeah, I think at this stage, you do have to look at some potential headwinds. One thing about the Canadian earnings compared to the U.S. is that we don't have as much guidance in Canada. I sort of call it three-down football. We don't really analyze Canadian banks the way we do look at JP Morgan, which we know what their net interest margin is going to be. It's $105 billion. Are they going to make it? Are they not? We don't decipher the earnings reports like we do in the States. We're more focused more on qualitative. How are we going to get to the ROEs, that type of thing. But I think the one thing that stuck out is that there's some tepid loan growth. RBC only had about 4% loan growth. So with our economy going through some changes, we're going to get GDP tomorrow, but we'll have to sort of see how resilient we're going to be as a consumer. It's been a year of uncertainty and we've been resilient, but we really need to focus on the overall economy, and that's something that the banks need to look at as well.
And with the Bank of Canada, I mean, it looks like we're standing pat. We actually, I don't think I've talked about the Bank of Canada for nearly 5 days. What kind of an impact, if it stands pat with its rate, what kind of an impact might that have on the banks?
Yeah, good point. I think there is some room for Bank of Canada to make a move, follow the U.S. If the U.S. cuts, I think Canada will cut in line, which will further enhance the net interest margins with a more of a steeper yield curve. That always benefits banks.
But we're not really expecting that, though. I mean, the talk was we might even see a rate increase. What would that do?
I think with inflation, I think that if anything, it's going to be a pause. But I think that I look at the market as more potential of having rate cuts than rate increases. I think with the wave of mortgage refinancing coming on board here over the next couple months and over the next year and a half, I think that Canada's and their consumers not strong enough to withstand higher interest rates, and our dollar is holding up. So I think it's a case where our economy needs a boost, and any way it can get it. And I think that the lower interest rates would benefit the economy dramatically.
And international, going outside of Canada with the banks, any growth plans there for them? What direction are they heading?
Yeah, we're seeing that, of course, with Bank of Montreal sort of leading that way. Is that if you go down to LA, for instance, you're going to see a lot of advertising for Bank of Montreal. It's quite impressive. And the growth in the U.S. for Bank of Montreal, TD, Royal is extensive, and it's showing a lot of resilience. So with the U.S. and their fiscal policies and their expansion has really impacted that diversity as well. So it's a win-win for a lot of the banks in the U.S. right now.
Okay, Steve, we'll wrap it up there, but thanks as always for joining us.
Great. Thank you, Roger. Have a good day.
You too. Steve Rolls is Senior Portfolio Manager at Trivest Wealth Counsel. Well, shares of Gildan are under some pressure today after the company posted lower than expected targets for 2026. Stay with us on that. That's next. Shares of Gildan are seeing some pressure today after the Montreal-based company posted a full-year outlook that missed expectations. Here to break down for us is David Swartz, Senior Equity Analyst at Morningstar. David, thanks as always for joining us.
Thank you.
All right, let's look back first. Most of the numbers seem pretty good. A beat for the most part, just as at a quick glance.
Yeah, it was a very complicated quarter because the acquisition of Hanes Brands closed on December 1st. And most analysts, including myself, did not have any contribution from Hanes in the fourth quarter because the deal closed actually about a month earlier than expected. And so Gildan threw a lot of numbers at us this morning, and it was difficult to actually see how the quarter went, but it looked like it was a little bit soft, primarily on the innerwear side. But it doesn't really matter anymore because the acquisition of Hanes Brands is really much more important than the earnings in the quarter and also the outlook for 2026 and beyond. And so that's what people are really focused on. The stock price has been up a lot in recent weeks as people have tried to assess the value of Hanes. And it has dropped a little bit today, but I didn't see much bad news in the quarter. I think everything is actually progressing quite nicely. The company made a number of announcements this morning about its plans for the Haynes acquisition, including closing 2 of the acquired plants and expanding Gildan's existing facility in Bangladesh. So there's a lot of things going on right now. And so I think maybe people are just a little bit confused as to what the guidance is and also how the quarter went.
All right. And so does it seem like that the acquisition is going smoothly, or are there any bumps? Are there any bumps appearing?
I think it is going smoothly. It just started, it's only been a few months since it closed. And so there's a lot of work to do. Gildan did warn us this morning that there might be some supply issues this year because, as I mentioned, they're actually closing 2 of the plants they acquired from Haynes Brands. I think people maybe were a little bit concerned about that. Because it does suggest that there could be some product shortages that could affect sales. However, Gildan's management suggested it was really just going to be an issue of lower inventories, not a problem with actually fulfilling orders. And so we'll see how that plays out. But it really doesn't matter that much in the long run. It's really much more important to assess how the acquisition goes over the next few years. Gildan this morning said that they would have about $250 million in annual cost savings from the acquisition, which is more than the original $200 million that we were told last year. So from Gildan's perspective, it's actually progressing a little bit better than expected in terms of cost savings and integration. But there's no doubt that it's a complicated process because Haynes was about the same size as Gildan. And so essentially, Gildan just doubled in size. The company's never done anything like this before. And there's always a risk with the integration of a large acquisition that there could be unforeseen complications in many different ways that affect supply of products and also customer relationships and other things. But so far, anyway, it seems like the deal is progressing as expected. And I think it was a great deal for Gildan. I think it paid a very fair price for Haynes Brands, and that over time it will create value. My fair value estimates on Gildan are well above the current stock price. $93 on the U.S. shares and $128 on Toronto shares. So I think it was a strong acquisition for the company.
All right, and they're selling the Australian business, the Haynes Brands Australian business?
Yeah, that's right. So Haynes had a very large business in Australia. It's the market share leader in the country. But Gildan's management decided that it didn't really want to be in that business anymore. And so it did announce this morning that the business would be sold. The Haynes Australia business does about $675 million a year in sales. I think it could be sold maybe for $700 million or something. And that would be an unexpected cash infusion for Gildan, which would allow the company to retire debt more quickly because it did take on a considerable amount of debt when it acquired Haynes Brands. So cash from that deal as well as cash generated from the business should allow it to pay down that debt pretty quickly. But I think there has been some concern about that.
And would that be their focus then for sure, is the debt pay down?
Yeah, Gildan right now has put stock buybacks on hold. It still pays a relatively small dividend, but most of the cash is likely to go towards debt pay down. Gildan said that it will get its leverage down to 1.5 to 2.5 times. And I think that will happen pretty quickly, possibly even by the end of this year, because Gildan historically has not operated with much debt. Haynes has long struggled with excessive debt, but Haynes was actually making progress in reducing its debt before the acquisition, which is one of the reasons why it was more attractive to Gildan. And so, I think that process will continue and that Gildan will get back to having a very strong balance sheet very quickly.
And no concerns that Gildan might pick up the bad habits of Haynes with the debt?
No, I don't think so. Haynes' problems really go back many years. Between the 2013 to 2017 period, Haynes made a number of acquisitions, most of which failed, to be honest, and most of which have since been sold off. Now, the Australia business, which Haynes still owned and now Gildan owns, was a successful one, just that Gildan decided that it's not strategic for them, and so they're looking to sell it. But I don't expect that Gildan will be making any acquisitions anytime soon. The Haynes deal is by far the biggest deal Gildan has ever made, and I would expect that all the efforts would be towards integrating Haynes brands into the business.
And where do you see potential growth then over the next little while for it?
There's potential growth in terms of market share. Haynes had long underinvested in its production, and Gildan is very strong in its production of basic apparel. And one of the big benefits to Gildan is that it can apply those processes to the acquired Haynes business and potentially bring down costs, which would allow the Haynes brands to gain market share. Gildan historically has not been successful in building its own brands, but Haynes still has very strong market-leading brands. It's still #1 in men's underwear, for example, in North America. And Haynes has been gaining share over the last few years. And so with Gildan's production processes and Haynes' strong brands, it creates a stronger business for the branded business. And then on Gildan's printwear, Haynes was a competitor in printwear as well. So Gildan bought a competitor there, which should allow Gildan to gain market share in the printwear operations as well.
All right, we'll wrap it up there. David, thanks as always for joining us.
Thanks.
David Swartz, a senior equity analyst at Morningstar. Coming up, Quebecor beat on revenue and adjusted profit in its most recent results. We'll talk to the CEO about what's driving these numbers after the break. We are watching shares of Quebecor today after the Montreal-based telecommunications company posted results in mobile subscriber growth that beat analysts' estimates. Joining us now is Pierre-Karl Péladeau, President and CEO of Quebecor. Pierre-Karl, thank you very much for joining us today. Let's talk about the beat. Where did it come from?
Well, certainly, after the Freedom Mobile acquisition that took place about 2 years ago now, we've been able to create pretty interesting momentum. I would say that, basically it's we've been able to follow the lesson we applied when we started in the wireless business in the province of Quebec. And we've been successful because we offered, what the customer was looking for, which was customer service. And I think that for the 15 consecutive year, we've been #1, and this is certainly something that position ourselves as unique, but also with pricing, innovation, and this is what we've been able to achieve. First, as a quote-unquote classical wireless operator with Videotron, but then we launched the first only digital wireless service under the brand of Fizz. There's no such a thing like a call center. You go on the internet, you dial what you're looking for, you pay, and you will receive your phone will be activated. So again, we've been applying this formula, this winning formula, in the different other markets that Freedom Mobile was servicing. Unfortunately, at that time, since Shaw acquired it, and as we all know, they decided that they would not like, the Shaw family to continue, and then the Shaw-Rogers transaction took place. But under the Shaw management, and in fact, this is what Brad was saying, and it's true, it's expensive, it's capital intensive, this business. You need to be ready to invest to make sure that your network will be able to follow what the quality of the service you'd like to offer to your customer. Okay. So that was an opportunity for us, and we invested, obviously, and we will continue to invest to make sure that the quality of our network will improve day after day.
I was going to say there's some analysts arguing that the CapEx is going to have to increase over the next couple of years, especially areas like BC, Manitoba. Do you intend to spend more?
No, we will continue on the trend that we've been able. We invested in the past. We shouldn't hide the fact that we've been helped by the regulation. I said because if you go back, in 2008, they decided that they were looking to have competition in Canada. So there were kinds of rules that will give the opportunity for new entrants, to come in the marketplace. We did it in Quebec by buying spectrum, what we call set-aside spectrum. We built, we start building. We went after as a MVNO. And today, we have the roaming environment. So we have the capacity, to roam or to use other operator network. Obviously, not for free. They charge for us. So we're able to offer a national service and international service also by having deals and packages with other international operators. So we're not forced, to invest. So it's a balance between investing on our new network and using roaming. So we do not have a need to do it other than to respect our obligation that we took with ISED, which is the industry minister department, and for which we bought spectrum. So we're not forced to get crazy. We have the capacity to continue to invest, and we will continue to do it.
Does that mean that if you're going to invest at a fairly consistent level, free cash flow, are we going to see share buybacks, dividends, acquisitions? Where are you heading with it?
Well, this year, we were able, to get more than $1 billion of cash flow. Free cash flow is, the EBITDA minus the capital expenditure, minus the interest that you're paying, and minus the income taxes. This is the cash available for distribution. Then how will you distribute that? You can reimburse your debt, and this is what we've been doing. You can repurchase shares, and this is what we've been doing. And you can pay dividend, and this is also what we've been doing. In fact, the board of directors announced in the press release this morning that we are increasing the amount of dividend paid per share by 15% because we have the capacity of doing so. The payout that we have on our EBITDA, on our free cash flow, is about 35%, and we a few years ago mentioned to the market that we will pay, our payout will be between 30 and 50%. So the bracket we're really in the middle of it. In fact, a little bit lower than the average, so closer to the lowest bracket, the lowest side of the bracket. So we do not have any problems, to continue to pay dividend, and eventually, given our policy of the bracket I just mentioned, to increase it in the future.
I just want to get in one more question about media. Revenue's up 23%, but that's a lot of that is because of that retroactive carriage fee settlement. Otherwise, your sports and entertainment down about 16%. Concerns about all that going forward?
Not really. Obviously, television and broadcasting is an issue everywhere in the world, and is an issue in Canada. You know probably because you're in this business, but we watch. You just have to watch what's taking place with Bell Media, with Chorus. The advertising revenues are down significantly. Subscribers also, because cable is not a growing business. In fact, it's a declining business, and therefore the subscriber base is an erosion, every day and every month. So we need to work on expenses, and this is what we've been doing for the last 18 months. It's unfortunate, because, people, some people lost their jobs, but, we need to make sure that, the rest will continue to live and to prosper. So this is what we're doing. And for sports and entertainment is really small in the overall revenue base that we have.
Okay, we have to wrap it up there, but Pierre-Karl, thank you very much for joining us.
It's a pleasure for me. Thank you, Roger.
Pierre-Karl Péladeau is president and CEO of Quebecor. Up next, we'll be joined by the CEO of EQ Bank to break down their latest results and how Ottawa's new fast-track fintech rules could reshape competition in Canadian banking. Stay with us. Canadian Conservative leader Pierre Poilievre says China cannot serve as a substitute for the U.S. In a speech to business leaders, Poilievre condemned Prime Minister Carney's recent outreach to China and says Canada's prosperity and security are inseparable from a stable relationship with America. Poilievre also proposed a new tariff-free auto pact and called for a full exemption from Buy America rules, as well as a relaunch of the Keystone XL pipeline project. Shares in Canadian Utilities are under pressure. The company posted net income in its fourth quarter that fell short of estimates and also missed on revenue. The energy and utilities firm says the results stem from regulatory issues as well as the wind down of a 2024 efficiency program. There was also a write-down of assets in its Alberta portfolio after repeated power curtailments due to weaknesses in the province's electricity grid. Shares of Northland Power are rallying today after the company issued a profit forecast for 2026 that came in higher than expected. Northland also posted revenue and profit that exceeded expectations, boosted by outperformance in its offshore wind business. Sales in that segment surged 38% compared to the year before. EQB is out with its latest quarterly results, showing continued growth in its customer base and overall cost structure. At the same time, Ottawa's new fast-track framework for fintech licenses is shifting the competitive landscape as EQB moves ahead with its PC Financial acquisition. Joining us now is Chadwick Westlake, the CEO of EQB. Thanks very much, Chadwick, as always, for coming in and joining us. Let's talk a little bit about some of the highlights. EPS, 226, up 48%. Where did that come from? What did you do?
Sure. Thanks for having me again, Roger. And before the numbers, maybe I can just say this is such an important time for the Canadian banking industry. And Canada's challenger banking is leading the way. And more competition, more choice for Canadians. We're very purpose-led, very intentful in trying to improve Canadian banking. So we're making great strides. And this was a quarter of doing what we said we were going to do. We said we'd improve efficiency as a competitive advantage. We improved almost 500 basis points in one quarter. We said we were going to improve ROE back to our 12% outlook for this year and back to our medium-term guidance. We increased ROE and EPS, to your point, almost 50% quarter over quarter. So we're making great financial strides, but also doing very important things for Canadians. And that's going to hit a whole new platform when we close the transaction with PC Financial and start our Loblaw partnership.
And we're going to talk more about that, but with the efficiencies to improve that, where did you find them? What were you doing? Yeah,
we had a restructuring late last year. So it was a combination of some people and process costs where we became more efficient. A lot of this comes down to focus. How do you focus your capital and your resources on the things that matter most and really spend time on that, because you can get distracted otherwise. So we're focusing on where can we make the biggest win for Canadians and for our company. And that's where some of those changes came in. So there was some reductions in staffing, and we thought through our balance sheet a little bit differently and focusing on where we can win. And that's the outcome of that.
And when you say you rethought on your balance sheet, what were you doing? How were you rethinking things?
Yeah, there's some projects and some products where maybe we weren't winning. So we're doing a little bit less in some others and focusing on where we're number one. And that's the outcome of that. So we were doing a little bit less in things like insurance lending and some other products, a little bit less time there, more on our core franchise, our core single family, core reverse mortgages, core commercial banking, things like that.
And AI, where's that fitting in for you? I mean, it's what everybody is talking about, and 2026 seems to be the year that everybody's really implementing. Obviously, you're using it. Where is it fitting in? Yeah,
right across the board. We actually just, for commercial banking, we had a new commercial loan origination platform that we're doing a lot of work with that actually increased our start to finish time about 30 to 50% actually in the actual loan approval process. So it was all AI within that process for commercial loans and right across the platform in terms of how we're doing adjudication, our back office operations, all of it. And it's sort of what will differentiate you is not only the AI, but how you use that AI to become even more efficient and effective for customers.
Now, with the way your bank is set up, is it easier to implement AI?
Absolutely. So we're well over 90% cloud-based, 100% cloud-based in EQ Bank. We have an excellent partnership with Microsoft. We're based on Azure, and we actually have a very open API infrastructure that enables us to bring in fintechs and actually scale even faster with AI as well.
Okay, and going back just to talking about challenger banks and the opportunities, what opportunities do you see? Because I mean, there's not a lot of room anymore. There's just a few banks, and we've seen population stall. So where are you going? How are you building, and how are you growing?
Yeah, when we close PC Financial, for example, that will be one big step. So I think day one, We quadruple our customers. We nearly double our revenue. We add new distribution channels. And importantly, we then have PC Optimum that becomes part of all of our products. So we're going to have an opportunity to be more visible to about 17.5 million Canadians and bring in millions of direct customers. So we're going to make an impact there where they may not know EQ Bank today. So we're going to bring them our no-fee, low-fee products, our great digital platform, a lot more solutions we can bring to them. And you combine up this one new challenger. That's how we're going to make a difference. It's one of those things where if 80 to 90% of Canadians don't even know we're there today, with this transaction, they will. We have great products. We believe we have the number one products. We're going to bring them to those customers.
And where are you? I mean, I guess you're still waiting for approval, but how will you not step on each other's toes when you're bringing them together and not lose customers possibly because there's a lot of crossover and things like that?
Well, it's a net addition. So we're bringing in all that talent. This is about growth in Canadian jobs. This is about growth and options for Canadians. So we've set up an integration management office, and this is a partnership, Roger. That's really important. Loblaw will become up to a 25% shareholder in EQB. They're going to have a couple board seats. This is truly about partnership and aligning under this EQ Bank brand and PC Optimum. So we're very organized on that sense. And this is so aligned with the federal government's intent on greater competition and greater choice for Canadians. This is right on point. And I think there could be a lot of urgency to go even faster here. This is going to make more choice and better companies at the end of the day.
Now they're fast tracking the licensing framework for fintechs. I mean, where do you see that going, and what do you think of it?
I think that's fantastic. I think the more choice and more competition, the better, because that will drive the incumbents to improve pricing, products, innovation even faster, and that will get us to the table even faster to be visible, to bring more choice to Canadians. Every dollar capital we generate goes back into Canada. With this transaction, everyone has a job. This is about growth, truly, and choice. So we'd like to go faster, further, and make a big difference to Canadians now.
And what's the focus? I mean, obviously, PC is a big focus for this year. What else, though? Where are you hoping to take this? Yeah,
well, outside of PC Financial, we're focused on our core franchise. So businesses like reverse mortgages, we just grew another 5% sequentially, and making a huge impact because there's actually not a lot of education in Canada about what that can do for customers. CMHC insured multi-unit lending is a big priority for us. Our single-family business, where we serve underserved, especially borrowers for self, that are very important to Canada. And our digital bank, EQ Bank, that platform, we just added another 26,000 customers quarter over quarter. And there's huge potential to continue to grow that. But you add it all together with PC, you have a very complete product shelf. So completing that product shelf is very important as part of this.
And with the residential mortgages, are you feeling pressures there?
Yeah, well, look, we reflect everyday Canadians. So you certainly saw there was some early delinquency, but that's very, very early, right? Actually, the portfolio is performing exactly as we expected. Even from last quarter to this quarter, we said we thought we'd see some improvement in PCLs. And we did. It improved 28% quarter over quarter. And our conventional lending for single family expanded another 2% quarter over quarter. So there's growth there, but we're not chasing growth. We're focusing on some key markets, especially like Quebec, for example. We had a great quarter. Mm-hmm. So there is growth there, but people are struggling. You know, you have to reflect that, and the housing market is muted in its growth. So we're choosing where we can win very, very thoughtfully. Okay, we have to wrap it up there, but thank you very much, as always, for joining us. Thank you. Appreciate you coming in. That was Chadwick Westlake, the president and CEO of EQ Bank. Coming up, Warner Brothers' fourth quarter results, posted amid a fresh takeover bid, the latest after this. Warner Brothers reported lower sales earnings in their fourth quarter as the company weighs a new takeover offer from Paramount Skydance, $31 a share, which could outbid the company's current deal with Netflix. For more on this, I'm joined by Robert Fishman, senior analyst at MoffettNathanson. And Robert, thanks as always for joining us on the latest episode of the love story. Not so much of a love story, I guess. I don't know what it is right now between these three. $31 a share. We're going to talk about that in a second. Let's talk about Warner Brothers, their earnings, first of all. What kind of a factor is that in the midst of all this?
Well, I think it was a proof point, right? Talking about how successful they have been in terms of monetizing the content. You know, we've seen that through the success that they've had at the studio, and that they continue to build momentum on the streaming side, reaching the subscriber goals that they've laid out, and continuing to grow internationally as they roll out in some of these key European markets that will help them continue to expand their growth in 26.
Now, sorry, and this was Warner Brothers. We were talking, just to clarify. But their numbers, their revenue was down, though. Is that any concerns there, or is that just part and parcel for the business right now?
Yeah, I mean, clearly there are challenges that are well understood, I think, on the network side, given the backdrop and the challenges really facing the industry there in terms of cord cutting and advertising on the linear network. So that remains a continued overhang, and part of the reason why they decided to split the company initially was to try to get that value out of the streaming and the studios, and not allow for the networks to be that overhang on the value, thinking about the stock price before all this began.
All right, and let's talk about this, the latest offer from Paramount, $31 a share. You don't think it's going to do it?
Well, I think what we've heard so far is the $31 that the board continues to evaluate is likely to lead to a superior proposal as defined by the merger agreement, which will then allow the companies, Paramount, Skydance, and Warner Brothers, to again, continue that negotiation. So that's what we're waiting for, to see how this plays out from this increased bid on the $31 that you mentioned.
And where do you see this going? Assuming it does move forward, what's a reason, or not a reason, but what's a price you think it'll end up at?
So we expect Paramount to go to at least $32 on this round. And then it's up to Netflix to see if they want to match that they have 4 days to come back and reevaluate. The math that we've done has suggested that, and there's lots of different ways that you can come to this from the outside. Obviously we don't have the perfect amount of data from the inside. So from Netflix's standpoint, they can make the math work what they want to, but they continue to talk about how disciplined they're going to be. And so we think that up to $30 on the Netflix side, which again, sorry for the complexity, but it's not apples to apples to the Paramount bid, because Paramount's bidding for the entire company. Netflix is just bidding for that streaming and studio asset.
And you think it could end up at $34 a share even? And would it be worth it at that point?
Well, for Paramount, I mean, what we continue to believe is this is really a must-have for them. So to the extent that they need this content and need the streaming service in order to help what they would say accelerate their own growth, but what we would argue is to really help truly deliver the growth that they're expecting as part of their standalone company, to try to pivot to a real scaled player streaming-wise globally. That's why we feel that this is more of a must-have for them. So when you say, would it be worth it, I think it comes down to how you want to define success with it or without it. And without it, we think it would be a much more challenging road.
And how much of a wild card is Larry Ellison in this? I mean, is this the feather in the cap, and he really wants this, and that's why he's been so involved and pushing it so much?
I mean, he clearly plays a very central, critical role within all of this. What we've seen along the many different increased bids on the Paramount Sky side was essentially first the unwillingness or not wanting to really give his personal guarantee, but that was something that the board very much, the Warner Brothers Discovery Board, pushed for, and eventually he did accept that term. So there's a lot of central places in terms of how Larry Ellison plays within this context. And eventually will be one of the biggest deciding factors in terms of what that price is going to be.
And then, of course, from the other side, Netflix, can you see them coming back?
Yeah, so again, our math suggests that they can definitely increase their bid, but they remain very committed around this being disciplined, and that this is not must-have for them. So if you believe that and take them at their word, I do think that they have a growing willingness to walk away from this deal if it becomes unattractive and the math becomes a whole lot harder to make accretive and to have strong returns on that significant investment. And they can put that money better use in lots of other places.
Well, and just quickly before we go, what other spots might they look for? Might they look if this one doesn't fit for them?
So I think that the whole idea of premium content is clearly an area of focus for the company. We would throw sports rights at the top of that list, including the NFL. And so we think that there will be opportunities in the next couple of years, or even as early as the end of this year, for the NFL to redo their contract and look to get early renewals out of their most important contract really in the whole U.S.
Okay, we have to wrap it up there, but Robert, thanks very much for joining us. Appreciate it.
Thanks for having me. Robert
Fishman is a senior analyst at MoffettNathanson. Still ahead, today's market movers with Bloomberg's Matthew Griffin. All right, for some movers south of the border, we're joined now by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us. And first up, we're going to talk a trade desk, and I think the execs are hiding under the desk right now.
Yes, Roger. Well, thank you for having me. And today is the latest leg down in just a slow bleed for trade desk stock, now down more than 70% since August. This is a company, they basically have software that matches ads to users online. And they gave an outlook today that was below what analysts expected for the first quarter. But that really is, again, just the latest blow here. They had results and an outlook that investors really didn't like back in August. They've been facing competition from Amazon. Now investors are worried that they will face competition from AI tools, and that's contributing to another slide of about 4% today. And again, adding up to the stock losing nearly 3/4 of its value.
Wow, if it wasn't for bad news, we wouldn't have any news at all. Okay, Papa John's also struggling. They're closing up shop, not closing up total shop, but a lot of them.
Closing up about 300, they said, underperforming stores, cutting 7% of their corporate workforce. The pizza chain, ticker PZZA, has been struggling with weak demand. They reported today that same-store sales in North America were down more than 5% in the most recent quarter. Wall Street was expecting a decline, but closer to 4%. And the company said there were a few things contributing, but one of them was a weak consumer environment. So this is one of the things you and I talk about down here in the U.S. We're all looking for clues about the health of the American consumer because there are a lot of sort of cross currents there. So this is another data point for investors to chew on. And in the case of Papa John's, it seems the cost-cutting measures they're taking, not enough to turn around investor sentiment for now.
All right, you got all kinds of puns in there. Is it the Wegovy and things like that? Is that what's driving this? People not eating as much? Or is it the economy?
I would guess it's more financial strain on consumers. It's interesting. I have looked at this question of are consumers cutting back on less healthy food, and it seems like maybe, but the effect is very, very small so far if it's happening. So we'll see what happens in the future. But I would say now it's more likely that consumers are tightening their purse strings rather than changing their eating habits for health reasons.
All right, let's sneak in this last one. IonQ is rallying. Of course, quantum is really it's the next AI, isn't it?
Well, it's certainly a cutting-edge technology, computers that can solve certain problems, perform certain tasks much faster than classical computers, as people call them. IonQ, actually a quantum computing company that has commercial revenue. They list their customers, including Airbus, Google, Microsoft, and they gave a better-than-expected revenue outlook today, reported better-than-expected revenue, and that is driving the stock up more than 20% today. Bloomberg Intelligence says it shows continued quantum adoption. That being said, quantum computing is a famously volatile corner of the market. Stock's still down about 50% from October. So it's definitely a place where investors
All right.
face some risk if they choose to get involved.
We got to go, Matthew. We got to wrap it up there. Thanks as always. Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. Have a great afternoon.